Welcome to the action, the power, the excitement of live radio. Starting today at the bottom half of the hour versus the top half of the hour. Hey, that's okay. This is Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. Melissa Fox riding in to save the day. On this week's program, we're going to talk about some 4 hard truths about retirement, along with some of the ongoing trends that have been happening in investor portfolios that suggest that folks may be getting a little bit too skewed in certain asset classes. All of that and much, much more on this week's program. Welcome to the program. An exciting week at the Garris House. We mentioned it last week on the program, but obviously it was graduation week, so my middle son graduated from high school, Boone High School, got a nice little graduation ceremony in at Amway Center. So kudos to the folks at Orange County Public Schools for making all of that happen in the midst of a pandemic. So there was a study done last year on over 3,300 different investor portfolios. And what was interesting about this study is it looked at the investment allocation, the investment mix of what folks had in comparison to sort of historical patterns and historical benchmarks. And there were 3 distinct trends that came to the surface that were a little out of skew with what they traditionally have been. And we thought these 3 trends were important enough to sort of share with you and try and draw some conclusions from what investors need to be aware of if they fall into one of these 3 categories or these 3 trends that are seemingly occurring across investor portfolios. So the first one has to deal with portfolio allocation to U.S. versus to non-U.S. And right now you've got portfolio allocation that on average is about 15% overweight to U.S. equities relative to the global market cap weighted index. So traditionally, if you kind of think of the world and the different types of companies that are publicly traded all over the world, you would find that if you invested purely on a sort of a market cap weighted where everybody is located type of basis, that your portfolio would be about 58% in the U.S. and about 42% outside the U.S. And if you look at the average investor portfolio today, what you will find is that it's about 74% in the U.S. and 26% outside the U.S. And so the reality is that since over the course of the past 10, 15 years, the U.S. markets have dramatically outperformed relative to the international, and so that has attracted a lot of new dollars, but even existing portfolios, if they haven't been rebalanced or readjusted along the way, would find then that their allocation to the U.S. side would of course be much bigger than what it was when it started out, because that has been sort of where the relative growth has been. But if you look at sort of the past 50 years or so, the U.S. equities market has lagged the international markets about as often as it has led the international market. So one of the conclusions of this study was that folks really want to look at that mix of U.S. versus international, because it has certainly gotten skewed in a lot of investor portfolios. And the reality is, if you look at the past 50 years, that U.S. markets, international markets, has certainly been about 50-50 in terms of who has been the leader during the course of a particular year. So if you're looking to improve your performance, you certainly want to have some balance of that U.S. and that international, and maybe look at rebalancing, particularly if yours has gotten as high on the U.S. side of things as the average investor portfolio has. Another conclusion of the study is that there has been a significant reduction to value stocks, and in essence, about a quarter reduction in the allocation to value stocks. And obviously that makes sense for a couple of reasons, right? The large growth companies, the names that we know, that we hear a lot about, Amazon, Google, Netflix, Facebook, all of those names are more growth companies. those have certainly been attracting a lot of attention these days from investors, but also goes to what we were saying on that U.S. versus non-U.S. side of things. If you've got an asset class that has done well and you haven't gone and engaged in a rebalance, well then guess what? You're going to be disproportionate to that asset class that has been performing well, because as that one has been going up, the others haven't gone up as much. If you do that over time, then you're going to be shifting your overall investment mix and maybe not quite realize it. So when you look at sort of just in the past 3 years, and so it's not a long period of time that we're talking about at how much things can sort of get a little bit disproportionate in your portfolio. If you look at sort of where things were in the second quarter of 2017, if you look just during that 3-year period of time, fast forward to second quarter of 2020, if in 2017 you had an even mix of 33% in value, 34% in blend, and 33% in growth, a well-balanced, fully diversified portfolio. Today, or at least not today, actually this study was done back in mid-year of 2020, what you would find is that you would now have 25% value, 41% blend, and about 35% growth. So that means then that your value has gone down by about 25%, or your allocation to the value side has gone down by about 25% during that 3-year period where you saw a big run up in growth blend type of companies. So again, investors need to be aware of that, because when you think about the success of this value versus growth, and understand the difference between the two, traditionally growth company will take its earnings and sort of reinvest, not necessarily pay a dividend. A value company, meanwhile, will take its earnings and ultimately use those to pay out dividends to shareholders and things like that. So, but if you look at performance over time, particularly over a 10-year period of time, what you'll find is that value actually, going back over the course of the past 50-odd years, that value, in fact, outperforms growth over a 10-year period of time, again, sort of like a full market cycle, to the tune of about 60% versus only about 40% on the growth side. So it's really important that investors sort of take a look at that mix of that growth versus value. If you're like most investors over the past 3 years, you've seen your value allocation go down by about 25%, just in terms of the normal behavior of the market. Again, underscoring the need to sort of rebalance things along the way. The same thing is also true in the bond side as well. So the average fixed income allocation to spread categories, and that's a term that is used to describe those types of bond funds that maintain a yield sort of greater than the U.S. Treasury of comparable maturity. So, in other words, it's bond funds that are looking for a little bit more on the yield side, looking for a greater yield than what the comparable U.S. Treasury is currently yielding. So those would be higher yielding than sort of the U.S. Treasury, and that's the notion of a spread category. But the allocation, the average bond allocation in investor portfolios to those types of categories where you've got bonds that are yielding a higher rate of interest has increased by about 66% over the course of the past 2 years. So what that means is that people, great, you've got your bond portfolio, and that's always good to have to help reduce your overall volatility, but the reality is that you may be incurring more risk to get there, and that certainly seems to be the case when you sort of look at these numbers where, back 2 years ago, it was about 12% of investor allocations were sort of to these spread, higher yield types of bonds, and today it's at 20%. What that does that you may not be realizing is that actually reduces or increases the risk, if you will, on your bond side of things, because if you're looking for higher yields in this type of market that's much more compressed, what you'll find is that you're going to be hard pressed to actually find a higher yield, because it doesn't really exist out there. the only way it exists is if you are looking for a bond that is a riskier bond, and then that ultimately means you're taking a greater risk on that bond side of things. So bottom line, what investors need to do, just as we've talked about those other two things, is really look at the mix of the bonds that you have and make sure that they're not all, that there hasn't been this big push to more the higher yielding side of things. Well, with that, we'll take a break and continue on with the program here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio, WFLA, Orlando. So on this segment of the program, we've got 4 hard truths about retirement. Some of the things that you need to be thinking about that you may not quite realize as you're getting close to retirement. So we're going to talk about those along with some of the solutions that you can follow to sort of avoid the hardness of those truths. Welcome to the program here on Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. It's certainly been an interesting program on this morning. Had a little producer issue. Melissa Fox stepped in, and so we are live here in the back half of the hour. We welcome all of our audiences on News Radio WFLA Orlando, along with 96.9 The Game, and then, of course, our friends over on the Space Coast at 92.7 WMMB. Also, of course, we're one of the top 25 financial planning podcasts on the World Wide Web, so make sure you subscribe to us on your favorite podcast channel of choice. Simply look us up by searching for Nelson Financial Planning or even Dollars and Cents with Joel Garris. That must mean that I'm Joel Garris. I am a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week, my birthday week actually, to help you change your life with a successful and cost-effective financial plan. So what are some of those 4 hard truths about retirement? Well, number one, and it's funny because as we were thinking about these are a bit of a reflection of some of the conversations that we have with folks as they start to think about or engage in retirement. And the reality is that a lot of people think that their living costs are going to go down. And the harsh truth on that is that they're really not. You're not going to magically start to spend less money and change all of your habits when you retire. And there's not some giant cost savings, if you will, on it, because a lot of people think, oh, well, I won't have to spend the money on gas, or I won't have to put the miles on the car, won't have to use dry cleaning and any of that stuff, although these days most places you don't need to worry about dry cleaning because everybody's doing casual. Anyway, those types of things are really minor in comparison to your overall spending pattern. So you still need home and food, and you still want to go on vacations, and in fact, you will have free time in retirement. And when you have free time, there's a tendency to want to go out and do things. And when you go out and do things, then you're going to need money to do that. So the reality is, and this is certainly what the studies have concluded, particularly in the first few years of retirement, you are in fact going to need more money to be available to fund your retirement. So really, when you're thinking about retirement, the solution really is to sort of ignore some of those old general rules of thumb out there. There's one out there that says, oh, as long as you're able to reproduce 80% of your income while you're working, then ultimately you're going to be fine in retirement. And we think that number really has to be 100%, that where you want your retirement income to replace 100%, maybe even a little bit more, of what you are currently doing in retirement. Because one of the big things that often people forget about is this notion of healthcare costs and things like that. That's one of the other ugly truths we're going to segue into next, particularly when you think about Medicare. Medicare, when people get on it, they're like, oh, great, I don't have to worry about paying for my health insurance out of pocket, and that was costing me a tremendous amount of money. Well, Medicare ain't free. When you think about your Medicare Part B premiums, those are typically around $150, and then the Part B only covers about 80% of those doctor bills and visits, and that means that for the other 20%, you typically wind up with a Medicare supplement. And so that supplement typically costs about $250 per a month as well. So all in, with Medicare, you get 65, you get Medicare, you're still going to wind up paying $300 to $400 per month on your health insurance per person. So once you get there, it's not still free, plus that you still got deductibles. And if you want the prescription drug plan, that's an additional cost. And then if you go see the dentist, that's a whole other cost. So just be aware that it is not a situation where your healthcare expenses are all of a sudden going to be magically taken care of because you're on Medicare. There's still a lot of costs associated with that you still need to make sure that you are covering out of pocket. And the more money you make, and this is something that's happening to more and more people because they haven't adjusted sort of the income parameters, but the more money you make, the more you will wind up paying for your Medicare Part B premium. So that's another thing to sort of be aware of, is that Medicare is not free, and there will certainly be a cost associated with your healthcare, even if you get to Medicare age. I think most people are aware, hey, if I retire before age 65 and I've got to pay for my health insurance out of pocket, it is a big amount and it has to be a line item in my budget. The reality is that even when you get to Medicare, there is still a cost associated with that on a regular basis. Next up on sort of the truths, some of the truths about retirement, or the hard truths about retirement that we're talking about in this segment of the program. And this one should be self-evident, but sometimes people sort of overestimate what they're going to get. And that is the fact that you can't live on Social Security alone. It's just not possible to do that. First of all, Social Security was only intended to replace about a third of your income. For the average person, they're only going to replace about 40% of the paycheck. It's just not enough, right? I mean, the average Social Security check is about $1,543 a month. So that's a pretty, low amount in terms of monthly income. That's just not enough, combined with the fact that if you haven't noticed it lately, the program is making some headlines that suggest that it may not be in perfect financial shape. So you certainly want to really think about Social Security more as almost like extra income that comes in later on. So devise your retirement plan to make sure that what you're doing and what you're saving is ultimately going to cover that retirement income. The reality is that think about that Social Security really more as extra income, maybe even covering some of those healthcare costs that we were just talking about that are additional expenses to the overall mix. So remember, you're not going to be able to live on Social Security alone. And then lastly, I think far too often people think about arbitrary numbers when they think about how big their nest egg has to be, right? Everybody kind of typically thinks about, $1 million nest egg, that does the trick. But the reality is that it really is unique to that particular person as to how much they need. We've seen plenty of people retire well with $400,000 or $500,000. So meanwhile, there's other folks that need $2 or $3 million. So it really is a more unique exercise. So we would encourage you to not really focus on kind of a number, but really more what your specific number really is. So those are some of the hard truths about retirement for you all to be thinking about here on a Sunday morning. We're going to wrap it on up and get on out of here. Thanks for listening to the abbreviated show here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning.